Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, September 7th, 2024. Hey, how you doing? I appreciate you stopping by for this weekend's podcast. I hope you're doing well. Boy, what an interesting week we had in the market. Oof. Well, the bears have awoken, and this is an interesting time. If you're long, it's been difficult, and this is the type of time right now where you need to be patient and wait for some setups. We are coming into some support levels, in my opinion, that might be interesting. But I had a call last night, a Skype call last night with a prospective student, and we were talking about the concept of everyone likes to buy something on sale except for stocks. It's for stocks, for some reason, people want to pay full retail. The headlines are good, the news is good, everyone's excited. But that's why I have certain parameters of where I don't buy. I like to buy things on sale, just like any other thing I like to buy on sale, but stocks in particular. So keep that in mind. Don't throw the baby out with the bathwater. I mean, adhere to your stops and so forth, but there are some interesting levels coming up here, some long-term levels, and we'll get into all that during the podcast today. So okay, so here is the format for today. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week. We're going to talk about when I entered them, why I entered them, what the strategy was, what the combination and confluence of signals were, where I made my entry, where my emergency stop is, where my end of day stop is, how I'm going to take partial profits if it moves my way. We're going to talk about significant overhead resistance levels where I may exit the entire position. All right, so we'll talk about those. I have trades, open trades, both on the daily time frames, also on the weekly time frames. I have some really nice open profits going in some of my positions. Some of them I got stopped out on as well, but that's just part of the business of trading. But we'll go through all those both on the daily and the weekly, and hopefully we'll give you an idea of how I look at the market, how I wait for trades, what the setups are, and so forth. So hopefully it will be helpful. And if it is helpful, I would appreciate it if you would hit the thumbs up button. It really does help the channel a lot to get those thumbs up buttons. So if you find something of value, I would really appreciate it. After we do that, I'm going to talk a little bit about trader psychology. Most important skill in trading by far, everyone, is the ability to create a plan, follow your plan. Be patient, wait for the setups, then enter the setups, and then follow the process. I can't stress enough how important it is to follow the process. You know, really, from a high level, trading is not that difficult. You wait for a setup, you enter the trade, and it's going to do what it's going to do. But what we as humans like to do is get in there and monkey around with it and think, oh, it's too high, it can't go any higher, so we get out. And then what does it do? Of course, it goes higher. Or it hits our stop, we don't get out, and we think it can't go much lower. And then what does it do? Of course, it goes lower, right? So you'll make your life a lot easier. You make trading a lot more simpler and more profitable, everyone, if you can just follow the process. I've been doing a lot of deep thinking about the process from speaking with students of mine, from speaking with other traders of mine, and following that process is the most important thing, and a lot of people don't do it. So that comes down to trading psychology. So I like to talk about a little bit about trading psychology. I hope that it will be helpful for you. After that, I have gone down through my master watch lists, both on the daily time frames and the weekly time frames, and I do have some potential trades for next week that are interesting to me. I like to do that I like to go down through my watch list on Friday nights, markets closed, and I look at the charts and I say, okay, where would be a nice confluence of signals? Where would be a good level that would be of interest to me? I mark that level. It's not there yet, but I mark that level because it makes sense. It's not there, but if it gets there, they will have this, that, and the other. And if it does get there, then I will consider taking the trade. It's at some major support, confluence of signals, would probably offer me a good risk to reward ratio. And so if it gets there, I'll take, I'll potentially take the trade. If it doesn't get there, I'll just go on to a new market. So I've got quite a few of them in different types of trades as well. Long, short, different strategies. So hopefully that will be helpful for you to kind of give you an idea of my thought process. And there are some interesting things coming up. Like I said at the top of the podcast, there are some interesting things coming up. Some weeks we have where it just grinds higher. There's really nothing there. If you remember when the market was at the top, uh, I wasn't looking for anything because it just wasn't in my zone, the areas that I was looking for. But now it is. So now it's getting interesting. So I hope you're staying safe out there. Hope you have a plan, a process, and that you are following. But hopefully, by taking a look at some of the candidates I have for next week, that will be helpful and kind of give you an idea of the confluences and the levels that I'm looking at. All right, so that's gonna be what we're doing. So hang tight. I'm gonna run the U.S. legal disclaimer, and I'll be back in about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, we have got a lot to get through today, which I'm glad because it shows a lot of different strategies and a lot of different things to deal with. So let's get going. Okay, let's start off with open daily positions. These are the Qs, QQQ. I did enter the Qs back on the 5th of August. And why did I enter this? Well, this is a deep dip buy and a nice confluence of signals. I did enter on the 5th here at 435.31. Why? Well, for three different reasons. The first reason is that during the day we opened up below the 200-day moving average and closed above. That is called an intraday rejection of the 200-day. That by itself is a legitimate signal, and that's a deep dip buy signal. But another deep dip buy signal is an under 30 over 30 on the RSI. Well, during the day when we opened below 30, closed above 30. So not only do we have an intraday rejection of the 200-day moving average, we also have an intraday rejection of the 30 RSI. So that's a confluence, that's a combination. In addition to that, we have a long-term trend line that during the at the open we opened below, we violated the trend line below and closed back above. So those are the three confluences that I took. Now it was really scary to buy down here. If you remember, that was a scary morning. But at the end of the day, it did close above the level. So I got long 435.31. Now, as soon as I get long, the first thing I do is I set an emergency stop. An emergency stop is the value of two ATRs. Right now, the value is 16.57. On the day that I bought it, it was different. It changes every day. So I placed my emergency stop two ATRs below. Now, if in the future it gets there, I immediately get out and I've lost 1% of my account. Now, the good news is that only happens about 5% of the time. It's rare that it happens, but you have to have that emergency stop in so that you have, worst case scenario, and if you position correctly, the way I position, if I do hit my emergency stop, I hit 1% of my account. But again, it only happens 5% of the time. The other 95% of the time, your end of bar stop is going to come into play. Well, on this trade, I took the trade primarily because of the under 30 over 30 and the intraday rejection of the 200. So my stop was a close below the 200-day moving average, okay? And 95% of the time, your end of day stop, if you have a loss, it's going to be because of that. Now, you see this orange line here, this horizontal orange line. What is this? This is my 1.5 ATR trailing stop level. So that's the value of 1.5 ATRs above my entry. Now, if I get there, I don't do anything. It just now means that I am in trailing stop mode, which means that if I reach trailing stop, in the future, if I have a close below a previous bar's low, I'm going to exit half of my position. All right. So the confluence of signals under 30, over 30, or intraday rejection of the 30 RSI, intraday rejection of the 200-day moving average, intraday rejection of the long-term trend line. That's the entry. Got in at 435.31. Position size correctly. Placed my emergency stop 2 ATRs below my end of bar stops, closed below the 200, and my trailing stop level was up here at 452.20. These are all defense. So far, what we've talked about are defensive moves. If it goes against me, if it hits my emergency stop, that goes against me. If it closes below my end of bar stop, that closes against me. If it hits my trailing stop level and then I have a close below a previous bar's low, that goes against me. These are all defensive moves, but I like to play offense in my trading as well. And offense means that I am going to take partial profits if it moves the value of 0.45 ATRs from the previous bar's close. So let me give you an example. Let's just take Friday. Closed at 448.69. So I take 448.69, I add the 0.45 value, which is right now 373. I add those together. That gives me my first profit target for Monday. I take my first profit target, add the 373 to it again. That gives me my second. I take my second, add it to it again. That gives me my third. So and I always place 3 limit orders in the system at those profit targets that I just went through, and I have to do it every day. And I take off 10% of the remaining shares that I have, because if I had profit targets in the past, of course, it reduces my position size, right? So you can see when I entered the very next day, it went up nicely. I took off 2 profit targets, not all, right? But I took off 2 profit targets. Next day, opened higher again. I took some more, then it reversed, moved up again, took some profit targets here, here, and here. It wasn't enough to take any profit targets here on the 13th. Hit more profit targets. Next day, nothing. Believe I hit 3 profit targets on this day. So I'm scaling out as the market is giving me something. And so it's reducing my position size on the way up. And that's really how I like it. So profit targets, some profit targets here. Here was the first, on the 22nd, was the first close below the previous bar's low. So my trailing stop rule initiated, and I took off half of the remaining shares that I had, right? I started with the normal amount here, scaled, 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 scaled. So I have fewer shares. And here I take off half of whatever I have remaining. Now, this long-term trend line here, look at this, was just perfect. We got up into that trend line, we rejected, and then came all the way back down. We also got into a bearish order block up here as well, and it was perfect. And so I'm really glad that I took off half the position size at, let's see, that was about 8.59%. Thank goodness. This is a very good example of why I like to take profits on the way up, have that trailing stop level, because it significantly reduced my position size for this big down move that we've had. So now look at this. We are getting close to the 200-day moving average. Now, Monday, if it closed under the 200-day moving average, what would I do? I'd get out of the remaining shares that I have, right? As long as it stays above that 200, I'm going to keep them. If Monday it rallies a little bit, if it rallies at least $3.73, I'll take another profit target off, all right? So anyway, so far on the remaining shares that I have on this particular trade, it looks like Oops, it looks like it's up about 2.87%, but I'm clearly up a lot more on the trade because of the taking profits when times were good and getting out of half here. So this is a great example of why it's important to take partial profit targets, at least in my opinion, and the trailing stop rule as well. But the remaining shares up 2.87%. All right, let's go to UNG. UNG, different strategy here. Um, and by the way, I do use 7 different strategies in my trading. Deep dip buy is just one of them. And also, by the way, I do teach private one-on-one lessons in the evening time via Skype. I've been trading for 29 years. I have really good approaches, really good strategies, and I have a course that's one-on-one where I teach my student all 7 of the different approaches that I use. I teach them step by step. We do all sorts of simulations. Um, so not only do I teach you, but I make you prove to me in the simulations that you know how to trade. I've taught people from all over the world, from absolute beginners all the way up to hedge fund managers. I love to teach. I know that I teach really good things. So if you would like to if you'd like to improve your trading, I promise when you're done with this course, you will be a better trader. So my email is in the link in the description. Feel free to reach out to me. And we initially just have a free Skype call and get to know each other a little bit and like to learn more about your trading. And it's a good time for you to ask me questions. And I tell you, I've had a lot of students contact me lately. So, but I'd love to talk to you, love to teach you what I know. So my email's in the link of the description. So this is what is called an abandoned baby. If you look back here, you can see this bar that I highlighted in green. This is an abandoned baby. What makes it an abandoned baby? Well, the previous day it gapped down, and then the day after it gapped up. So we gapped down, there was bearish sentiment, immediately followed by the gap up, which is bullish sentiment. And what I have noticed is when this happens, usually when you look out into the future, you are going to be higher than you were when that happened. Not all the time, obviously, but more times than not. So after this abandoned baby here, I did get long at 1309. Now, on this particular strategy, I simplify it to a large degree. I place a 2 ATR emergency stop below, and I place a 4 ATR profit target above. So that's good risk to reward. It's an asymmetrical risk to reward. I'm risking 2% to make 4%. In my experience, abandoned babies about 70% of the time will reach their 4 ATR profit target and only 30% of the time reach their 2 ATR stop. So in general, if you're 70% of the time you're making twice as much as what you're losing, that's a pretty good proposition, right? And in addition to abandoned babies, I also teach island reversals. They're exactly the same thing. It's exactly the same approach. It's just with island reversals, it's not one bar, but it's multiple bars. So I enter this in. I place a one cancels another order. Uh, the stop 2 ATRs above, profit target 4 ATRs. I'm sorry, 2 ATRs below if I'm long, and 4 ATR profit target above. And that abandoned baby took off perfectly. I was like, oh man, this is going to go right to the 4 ATR. Didn't. It got close, but then it came all the way down, and I actually got negative on the trade, but we're back on the right side of things. And so this particular trade with the abandoned baby is up right about 8.52%. So it's been a good trade. And by the way, if you'd like to learn more about abandoned babies, island reversals, go to my YouTube channel. I have a video there that's free that you can take a look. Just look for the abandoned babies and island reversal video. So, so far on this abandoned baby, up 8.52%. All right, let's go to Tesla. Tesla. Boy, this has been straight up and straight down. This is a deep dip buy, everyone. I did buy Tesla back here on the 28th of August. Why? Well, it was an intraday rejection of the 200-day moving average. I got long here, 206, placed my emergency stop 2 ATRs below, My end of bar stops, a close below the 200-day moving average. I place my 1.5 ATR trailing stop level, and of course on the way up, I take partial profits. Next day, went up, I hit a profit target. Next day, went up, hit a profit target. Next day, went up, hit a profit target. Next day, went up, hit a profit target, and got to trailing stop level, which is important. I don't do anything. It's just that now in the future, if I have a close below previous bar's low, I'm going to get out of half. Next day, went up strongly on Thursday. I hit 2 profit targets. So you can see after what happened on Friday, I'm really glad that I took these profits while I had them. So on Friday, we had a close below a previous bar's low after reaching trailing stop level. I took off half of the remaining shares at profitable levels still, right? So far, the remaining shares that I have are up 2.9%. But again, the importance of taking the profits when you have them. So if you have this huge reversal like we did, I got out up here, I got out up here, I got out up here. And now my position size is significantly reduced. I still have some, right? But it's significantly reduced because we had a close below a previous bar's low. Um, um, and of course, my trail or my stop is if we close below the 200, I'm out of the trade. But again, it shows you why taking those partial profits and that trailing stop rule is important. But the remaining shares up here, 2.09%. Excuse me. VIX. Okay, big trade on VIX for me. And this is what a different strategy. This is a bullish order block. You can see this green box down here. What is this? Well, this is a buyable area. And you might ask, why is it a buyable area? Well, it takes a little while to really explain this, but in general, this box consists of the high and low of the bar on 723. Why is that significant? That was the lowest close before market structure changed to the upside. We changed market structure here because we took out this swing high. So you look for the lowest bar close before that happens. And again, the high 43.88, the low 42.68. If it were to come back into this order block, bullish order block, well, that's the time for me to buy it. And I did buy it back here on the 19th of August at 44.70. So I buy it. I place my 2 ATR emergency stop below. My end of bar stop is a close below the low of the order block. So 42.60. So it's a good risk to reward. I place my 1.5 ATR trailing stop level above. And then, of course, if it moves up, I take partial profits. Now the range is so big to take partial profits, it was quite a bit. So I didn't even take any here, moved back down. Here, of course, I believe I hit 2 profit targets or 3 profit targets. Then nothing here, and I did hit one on Friday. So I am at trailing stop level. If I get a close below a previous bar's low, I will get out of half. If it continues to move up, I'll continue to take profit targets. If it gets up to 65 RSI, right now we're at 57.51, then the 5 EMA will come into play. So again, a lot of rules, but I have every rule that I use and that I teach in my one-on-one. It's there for a reason. It's not there for no reason. It is there for a reason, so that I have an exact plan. I have an exact process of how to trade. And like I keep saying this, but please get yourself a process. Please get yourself a plan. If you do, and if you follow it, your results will be much, much better. Whether you learn it from me or someone else, please do it. So this particular trade, the remaining shares on this trade doing very well, up 20.05%. Thank goodness, because I had some losers too, right? I had some long losers that I had to get out of. So this really helps. So this long VIX trade up 20.05% so far. Okay, McDonald's. McDonald's is a short position that I took on Friday. So I did get short Friday yesterday at right here at about 289.50. So right about the closing price, because I do enter my trades at the end of the day. I got short. Why? Multiple reasons here. Let's start big picture. Look at this high here. Look how high the green MACD bars are. Okay, MACD bars are a momentum indicator to showing the strength of the move. So we had a big strong move with tall MACD bars. Then we pulled back, we went red, and look what happened on Friday. Friday, during the day, we actually were higher here than we were at these highs. But look, no green whatsoever. So even though we went higher, it was not confirmed by the green MACD momentum bars. This shows me, and this shows me that momentum on this last move up was not the same as this move up. So it's indicating that the buying momentum is waning or getting less, and it also so it just indicates that you're running out of buyers essentially. So if you run out of buyers, the implication is that you are heading down. This is how people use MACD, both to the bullish side and to the bearish side. So again, we took out this high, rejected it, so it's a false breakout to the upside. We have a bearish MACD bearish double top with negative MACD divergence. In addition to that, look at this trend line here. We broke the trend line to the downside. Now we've come back up and we rejected the trend line above us. It is now resistance above. So those are the confluences. False breakout to the downside, or false breakout to the upside, double top with a bearish MACD divergence, a rejection of the trend line that is above us. And in addition, look at the RSI, 69.13. We rejected the 70 RSI. If I was long McDonald's and we rejected the 70 RSI, I would take off half of my position. That's one of the rules that I use. But I'm not long, but I got short because of the double top, or the false breakout to the upside, the double top with the bearish MACD divergence, the rejection of the trend line, and the rejection of the 70 RSI. Now, do I know this is going to be a profitable trade? Absolutely not. But I know exactly what I'm going to do. I mean, all the components were there to get me short this trade. So where are my stops on this? Well, my end of bar stop is simply going to be a close above this high. So it's pretty close. If I'm wrong, 290, 220. My emergency stop is obviously 2 ATRs above. And if it gets there, we know what I do. I have to get out immediately. My trailing stop level is 1.5 ATRs below me now, 283.10. And if it moves down, I will take partial profits. So it's a good setup. I think it's a good teaching moment here of looking at a short position with multiple confluences happening at the same time. I'm basically completely even on the trade because I just got into it. So we will see what happens. Okay, let's go to the closed out trades. All right, well, I was short UAL, and apparently UAL was the only stock that went up on Friday. I couldn't believe it. I got short on UAL here on the 5th of September, Thursday at 45.10. Why? Well, we had a rejection of the 200-day moving average. Not only that, but we also had a death cross. We had the 50 crossing below the 200. And I have noticed when you have a 50 crossing below the 200 and then you go back up to the 200, the first rejection of the 200 is a pretty good shorting area. My risk to reward's very good, so a close above the 200, I'm just out. And look, I'm out the next day, which also is a good thing to point out. Usually when I'm wrong quick. If you see me out in a day or two, it's because it was a loss. If I'm in a trade for 7 or 10 days or 20 days or a month, I'm in it because it is working. So it's important to uh, uh, be very impatient with your losers, be very patient with your winners. That's really it. So it was a losing trade, down 2.02%, but it's fine. I saw the setup, death cross, first rejection of the 200 after the death cross happens. More times than not, that trade will work. This one just didn't work, and a loss of 2.02%. I want to show you AMD. Look, here we have the 50 crossing under the 200. We rejected the 200-day moving average, and look at that. That was good, but this one just didn't happen for UAL. So this one, a loss of 2.2% on that short. Google, oh boy, this one was not good. I had a lot of hopes for this trade, and probably a good teaching moment. This had so many confluence of signals. Like I said, I had a lot. I had a lot of hope for this trade, but even it doesn't matter if you have 100 confluences. It doesn't mean it's going to work. I got long Google here on the 3rd of September. Why? Well, we bounced at the 200-day moving average. I got long 157.30. In addition to that, we had a bullish order block similar to what I showed you on VIX. And for a couple days, it did hold that support at the 200, and then boom, it just puked on Friday. So I had to take the loss. It was a loss of 4.31%. Not fun. Do you see how we got almost to the 2 ATR? Didn't quite get there, or the 2 ATR emergency stop didn't quite get there, but regardless, it obviously closed below the 200. So yeah, it was a brutal day on Friday, really outsized moves. But that's part of trading, everyone, right? And I position size correctly. So no matter what happens, I have to be okay with it. So a loss of 4.31%. Microsoft, okay. Good example of trade management. I did get long Microsoft all the way back here on the 9th of August with the close under, close over the 200. I got long at 406.02. My emergency stop 2 ATRs below. My end of bar stop a close below the 200. My 1.5 ATR trailing stop level. Here we move up. I take some profits. Nothing the next day. Next day took some profits. Got to trailing stop mode. Then here on the 22nd of August was the first close below the previous bar's low. So I took off half, and I took off half for, let's see. Why is that? Oh, yeah. 2.75% gain. Not too bad. No, I'm sorry. It's moving. There we go. Yeah. About a 2.68% gain on half of the remaining positions. Then we moved sideways. We didn't do much on this particular day on the 29th. I was glad that I took some profits at the top with the partial profit approach. And then here on the 3rd of September, I had a close below the previous bar's low, just barely, for a gain of, let's see, 0.87%. So it was still a gain. And then am I glad that I got out? Absolutely, because again, we had the puke there on Friday. So again, it shows the value of taking partial profits. It shows the value of the trailing stop level and taking off half, and having a good risk reward ratio just to begin with. So the gain of 0.87%. All right, Pfizer. Boy, I have a lot of trades. I usually don't have this many trades. Pfizer, this is what is called, this is a different approach. This is a higher low V2. A higher low V2, I got long at 29.02 because of the V2. A V2 consists of 3 bars, bar 1, 2, 3. 2 goes below bar 1's low. 3 closes above bar 1's close. I got long 21.09. My end of bar stop was a close below halfway of the washout bar. This is a Fibonacci level. And the next day it just puked. So it was just, I was in one day, out the other day. And again, when I'm wrong, I'm usually long pretty quick. And I got out for a loss of 2.73%. So that didn't work out so hot tamale, but it's fine. Got to get out. It's a little higher than when I got out, but that is fine. So a loss on Pfizer. And then weekly trades, everything I showed you, I guess we'll just do a recap. Q's open position up 2.87%. UNG open position up 8.52%. Tesla open position up 2.09%. VIX open position up 20.06%. McDonald's open position totally even because I just took it. The closed out trades, UAL loss of 2.02%. Google closed trade out for a loss of 4.31%. Microsoft closed trade for a gain of 0.87%. And then Pfizer for a loss of 2.73%. Yeah, tough week. Tough week. Usually they're not like this, but we had a lot going on there. Okay, so let's go to the weeklies now. All right, weekly on Apple. I did get short Apple end of last week at 228.80. Why? Well, this is a bearish order block. On VIX, we talked about a bullish order block. This is a bearish order block. This is your highest close before market structure change, and then a check back into that. I got short here because the big bar here on the 19th of July, a big down bar. Well, from a Fibonacci standpoint, if you go back to about halfway of the big down bar, you're going to find resistance, and that's exactly what happened. So I got short 228.80. I placed my 2 ATR emergency stop, 2 ATRs above, my 1.5 ATR trailing stop below. And it did hit one of my profit targets this week because it was down 3.57%. So I did take some off, locked that in, and this particular trade currently up 3.70% on the weekly short on Apple. And the last but not least is Disney. On the weekly, I did get long Disney here on the 9th of August at 85.90. Why? Well, we had an intra-week rejection of the 30 RSI. And also, this line here is also the 200-day on the monthly, which was an important level. So I have a really good risk to reward ratio on this trade. Got long 85.90. 2 ATR emergency stop below. My end of bar stop is simply a close below 82.95, which is the 200-day on the monthly chart, which is an important level there. So we have moved up, did not get to trailing stop level. Otherwise, this is a close below a previous bar's low. Had I got to trailing stop level, I would have taken off half here, but it has not gotten there. But nonetheless, this particular trade still positive, up 2.47%. So the weeklies, Apple the short up 3.7%, Disney the long on the weeklies up 2.47%. So a lot of trades there, a lot of positions. My apologies for so many positions, but hopefully it was good because we looked at different approaches, wins, losses, and so we did a lot of reps on that. Okay, so before we take a look at the potential trades for next week, I want to talk a little bit about trader psychology. Again, it's so important, everyone. Really, this comes from the heart. You've got to get yourself a process, and you've got to follow that process, whatever it takes. Let's see. This is from Jack Kellogg in the New Traders, Rich Traders forum over on Facebook. And let's see what Jack has to say here. The outcome of a trade doesn't reflect your trading ability. The process you apply, your mindset and attitude will. So important, everyone. Listen, if you have a losing trade, doesn't mean you're a bad trader. Not at all. If you have a good trade, doesn't mean you're a good trader. Not at all. Don't get those confused. A winning trade or a losing trade does not make you a good trader or a bad trader. I had losing trades this week. I'm not a bad trader. I'm a good trader. What matters, what makes you a good trader is the ability to follow your process and your mindset and your attitude. That's what's important. The process you apply, the mindset, and the attitude. And more importantly than that, Jack, is the ability to follow the process. You can have a great process and not follow it. We know how to lose weight. We eat less food. We eat better food. We exercise. Guaranteed. Well, do we all do that? We do not. We don't. So you can have the best process, you can have the best roadmap, everything. You can have the best business plan, but unless you execute it, it's not going to matter. So having a winning trade, Having a losing trade doesn't make you a good trader or a bad trader. What makes you a bad trader is if you don't follow your process. Got it? Do you hear the intensity of my voice? It's important, everyone. There's lots of different processes. There's lots of different ways to trade. Most important thing, wait for a confluence of signals, have a good support level, have a good line in the sand. Under this line, I'm out. Over this line, I'm in. It's that simple, but to follow it. So the outcome of a trade doesn't reflect your trading ability. The process you apply, your mindset, and your attitude will. So anyway, hopefully that is helpful, and it's really true, everyone. All right, let's get over to the potential trades for next week. All right. Okay, let's start with Adobe. Adobe, ADBE, Adobe is held up much stronger than the rest of the market. And you can see this green box here. If you see a green box, that means it's a place I'm looking to buy. Why? Well, for one, we're at the 200-day moving average, the black line. That by itself is pretty decent. In addition to that, you see the gray line that we crossed over the 200? This is called a golden cross. I showed you UAL, I showed you AMD, the 50 was crossing under. Well, this one's the opposite. The 50 is crossing over. So when you have a 50 crossing over the 200, usually the first move back after that happens to the 200 is a pretty good bounce spot. So next week, I'm looking for potentially a bounce at the 200, an intraday rejection at the 200, or a close under and close over the 200. Okay, so the confluence is some kind of rejection of the 200, and in addition to that, we have the 50 crossing over the 200. That's what improves the odds of this trades. Oh, and I guess I should say, what do I have here? I have 12 symbols, potentials. Potentially, these could all trigger on the same day, but I have a rule. I only take one trade per day. If all 12 of these triggered on Monday, I'm going to have to narrow it down to the best trade. Well, how do I do that? I give a quality score to it. Maybe one of them had 5 signals and the others had 1 or 2. Well, which one am I going to take? I'm going to take the one that has the most signals. Which one has the best reward ratio? Which one has the most confluence of signals? Which one looks best on multiple time frames? Which one has the best relative strength compared to the market? This is how I narrow them down and give them a quality score. And again, this is what I teach my students in my one-on-one course. And by the way, I'm not sure if I mentioned, it's 15 hours. It's a long time. There's a lot of content. We do 5 sessions. Each session is 3 hours. So, but this is the devil's in the details. This is what I teach my students, how to take 5 legit trades and narrow it down to the best one. So here we go. So on Adobe, next week, if we reject the 200-day moving average, I'll consider the take-in trade. If it doesn't, then I'll just go on to something else that did. All right. Boeing. All right, Boeing looks pretty nasty. Why would I want to buy down here? Well, let's take a look at the bottoms here. Look at this bottom here. Look how deep the red MACD bars are. Now we are lower than here, clearly, and the MACD bars are not as deep. This is called the double bottom with a bearish divergence. All this means is even though this down move looks super nasty, it's not coming at the same momentum as this down move. So this is a double bottom bullish divergence. Really what it means, you are, from a MACD perspective, you are looking like you are running out of selling momentum. If you run out of selling momentum, the implication is that you go up. Now, just because we have a double bottom doesn't mean I just jump in and buy here. It just means the lay of the land, the big picture is, oh, this may be turning around. We're running out of sellers. So, but I need to wait for a signal so that I can structure the trade. Well, look, right now we're at 34.25. If next week we reject the 30 RSI, meaning that we go down, close below it, and then close back over it, or intraday we go under the 30 and close back above it, that's a legitimate deep dip buy signal. Now, I don't usually just take deep dip buy rejections of the 30 RSI by themselves. I need a confluence, but we do have a confluence, and the confluence is we have right now there is a double bottom with a bullish MACD divergence. So because we have this, if we do have an under 30 over 30, I would consider taking that trade. All right. So because of the double bottom bullish divergence, looking for an under 30, over 30. We're also down here at the negative third ATR channel. 92% of prices tend to stop going down when we get to that level. Look here, bounce. We are there now too. So even though this chart looks really ugly, there are some things underneath that looking like we may have a bounce. We're at the negative 30 ATR channel. We're getting close to the 30 RSI, and we have a double bottom with the bullish divergence. So I'll be watching that one closely. Anheuser-Busch, Budweiser, BUD. All right, well, we talked about uh, island reversals and abandoned babies. Well, we talked about them on UNG, a bullish. Well, this is a bearish one. Look, I marked it in red. Why is it bearish? Because we gapped way up. Man, everything was great. Everybody was super bullish on Budweiser. And then Friday, boom, we gapped down. So I could have taken that trade on Friday just there where it was. But when you have a bearish abandoned baby, a gap up and a gap down, what I have noticed is really the proper place to enter is if you get back up to the bottom of the abandoned baby. Now this may just head all the way back down and I will miss the trade, which is fine. But if we do rally back up to the bottom of the abandoned baby that happened on the 5th, that would be my short entry. I've just noticed from experience that is the proper place. All right, but take a look here. Look at this, gap down, sideways, gap up. That is a bullish island reversal. Now, there's no way I would have taken this bullish island reversal here. Right about here, because that's the top now, because this is bullish. This is the top of the island reversal. I remember seeing this and gapping up going, oh, I guess I should have taken it. But look, it came back down, closed the gap. Was that a good trade? It certainly was. But now things have changed. Now we have a bearish abandoned baby. So if we go back up to 63.23, that would be the place I would get short. I'd place a 4 ATR profit target to the downside, 2 ATR stop to the upside. So that's what I'm looking for in Budweiser. Caterpillar. All right, well, this one's pretty good. 200-day moving average. Last time, did it respect the 200 when it got to it? It sure did. Will it this time? I don't know, but it's more likely to do it this time if it's done it in the last time, but not for sure. But the reason that I like this here is the confluence of the 200-day moving average and the negative third ATR channel. That's why I drew a green box here. So yeah, I would consider getting long Caterpillar next week if we reject the 200-day moving average, because one, just because it rejected the 200, and two, because it's at the negative third ATR channel, and they're right there together. They've nested right there together. So that would, I don't know if it would be a profitable trade, but it's at a decent level with a confluence, and it gives me a good risk to reward ratio. Above Caterpillar, I'm in, and I'm bullish. Below 200, I'm out, I'm bearish. CCJ. Okay, CCJ, we're starting to finally get some double bottom bullish divergences. Not there yet. Look at this bottom here on the 5th. Look how deep the MACD bars are. We rallied, obviously. Green MACDs. We're getting close to coming down and testing this bottom. If we do, we'll have a double bottom. But I can already tell if we do test this bottom, we will have a double bottom bullish MACD divergence. Because if we come down here, test this bottom, we're going to have red here, but not anywhere close to the red over here. So double bottom bullish divergence, but I still need a trigger. What would the trigger be? Well, the trigger would be some type of rejection of the 30 RSI, because we're in the low 30s right now. So again, double bot, if we get there, we have to get there. But if we go to 30 RSI, we will get there. So double bottom bullish divergence, my entry trigger would be a rejection of the 30 RSI, and then I would get long, potentially. Dow Jones, DIA. Okay, this one's not so structured. Really, the only thing I'm looking here on the Dow is this long-term trend line. If we come back down, you can see where the green box is. That trend line may hold support. I don't know, but it may. But if I see it bounce at the trend line, I would consider getting in. This is a little unorthodox trade, but long-term trend lines do tend to be good areas of support. And so next week, for example, if we did come down bounced at that trend line, I would consider getting long. My stop would simply just then be a close under the trend line. But these long-term trend lines do add some significant resistance levels. It'd be nice if I got like a V1 or a V2 or something like that as well. But again, this is unorthodox, but if we come down, test that trend line, close back above, it just gives me a good risk to reward ratio at a good level. Google. Okay, so I had that really bad trade on Google, but when you have a bad trade on something, don't be afraid to get back in. What I'm looking at on Google here is the 300-day moving average. This is a deep dip buy. In deep dip buys, we use the 200, we use the 250, and we use the 300. Right now, we're under 30 RSI. Man, did that sell off. So two options for next week. One, if we go lower, some kind of rejection of the 300. Look, we just barely closed under the 250 as well. So if Monday we go up and close back above the 250, not only will we have closed back above the 250, we will also have closed back above the 30 RSI. That's a nice confluence, especially on a big stock like Google. A rejection of the 250 and a rejection of the 30 RSI. So for me on Google, two ways to look at this. If we go up and close above the 250 day, we will also close over the 30. I would consider getting back in long Google. If we go lower, some kind of rejection of the 300-day moving average, I would potentially get long there. So if it goes higher, I could potentially get long. If it goes lower, I could potentially get long. And let me point out here, look at this low here. Look how deep the red MACD bars are. We are lower now than here. MACD bars are red, but they're certainly not as deep as over here. So we have a double bottom bullish divergence. So I'm kind of stalking Google, big company, big monster, mega cap stock, but we are getting into some levels. And remember, I like to buy on sale, not full price. When you look back here, for some reason, everybody thought they had to buy up here. I'm not sure why. They were not getting it on sale. They were paying full freight. This is the time, if you get a proper signal, to buy when no one else wants to buy and get a good price on something. So again, if we go lower, reject the 300-day moving average, I would consider taking a long there, excuse me. And if we go higher and close above the 250, just by virtue of closing of the 250, we will have also closed above the 30 RSI. So I guess the point here is if you do get stopped out, but you're in those good areas, don't be afraid to get back in. I know it's hard to do, but there's a lot of signals here, potentials on Google. Intel. Well, Intel is certainly not anyone's favorite, but big picture from a MACD perspective, a lot of things going on here. Look at the low here. Look how deep the MACD bars are. Now we are lower now than over here. Look, there's not even any red bars at all. This is called a double bottom bullish divergence with a missing right shoulder. This is even a stronger signal than double bottom with just a bullish divergence. This is double bottom bullish divergence, but there's no red whatsoever. But I still need a signal. Well, the signal at this point would be an under 30, over 30, or potentially a V2. We formatted for a V2. Bar 1, bar 2 goes under bar 1's low. If Monday we go above bar 1's close, that's a V2. And by the way, if you want to learn more about V2s, I have a good video in my YouTube channel on it. Just look up V1 V2s. But normally I'm just not going to take a V1 or a V2 just as a regular entry signal, but because of the double bottom with the bullish divergence and the missing right shoulder, I would consider. So potentially on Monday, if it closes over 1940, which is day one's bar, I would potentially get in because of the very bullish double bottom bullish divergence with the missing right shoulder. Russell 2000, IWM. Okay, well, here's the 200-day moving average. Look, the last time we were at the 200-day moving average. Did it respect it? It certainly did. Will it respect it this time? I don't know, but it might. And it's right down here near the negative third ATR channel. So, if we bounce at the 200, I will potentially take IWM. But again, I have 12 symbols here. Remember, I'm going to narrow it down to the best trade. Will it be if IWM gets there on Monday? Do I buy it? I don't know. Maybe, but maybe one of these other 12 were better. Merck. Okay, we talked about this before. Look what just happened. We had the 50-day moving average cross under the 200-day moving average, the death cross. It's a red box here. That means I'm looking to short. If you have a death cross, the first time it goes back or checks back up to the 200, that, in my experience, has been a good place to short. If it keeps going down, I won't do anything. If it heads back up and rejects the 200-day moving average, just like I did on UAL, that didn't work out, but it's fine. I'll take it again because I know this particular setup works more than it doesn't. So if we rally back up, reject the 200-day moving average, that's a good risk-reward ratio, potentially take that. My stop would just be a close back over the 200. Microsoft, oof. All right. All right. Glad I got out of Microsoft when we closed under 200. But look, we have an interesting line here on Microsoft. This is a deep dip buy. This is a 250-day moving average, this purple line. Also in a bullish order block. In the green area is a bullish order block. The blue area is the 250. So and the 250 dovetails right with the negative third ATR channel. So a lot of things going on here. Major moving average, negative third ATR channel, and a bullish order block. So if Microsoft head back down next week and rejects that 250-day moving average, I would certainly consider taking Microsoft there. And the Qs, all right. Well, I am currently in the Qs. Really glad I phased out as per my plan. Really glad I took half here with the close over the previous bar's low after trailing stop. But we are getting back down to this 200-day moving average. And we are getting back down to the major trend line. Will there be support there? I don't know, but there's confluence there. There's a big confluence hanging out at that 200-day moving average. 200-day moving average, long-term trend line. I would, if I had to bet one way or the other, I bet you there are going to be some buyers showing up there. If we do go down next week and reject that 200-day moving average, I may go and phase into a full position again, because again, it worked last time. So there is some hope for the bulls if this level can hold. So on Qs, again, if we reject the 200 moving average, that would be a potential buy area. So those are the dailies. And again, all of these could trigger, but I'm only going to take one trade per day, the best possible setup, the best highest quality score, the most confluences, the best risk reward ratio, how we look on multiple time frames, relative strength, all this is important. Okay, let's go back. Let's go to the weekly time frames. Let's look at some weeklies. What do I have? 4. Again, I'm only going to take one of these. AMD. Okay, look, the place to buy AMD from a technical standpoint is right here where the green box is. You have the negative third ATR channel. You have the 200-day moving average, 200-week moving average, excuse me. Let's go back in time. Buying at the 200-week moving average, was it a good place to buy? Yeah, it certainly was. It certainly was. Does it mean it's going to be this time? I don't know. But if it respected it last time, it's more likely to respect it this time. It's still quite a long ways away. I don't know if it's going to get there. If it does, then I'll consider. That's what I was saying. Look at a chart and go, where ideally would I want to buy it? 200 makes sense. It's going to get there? Who knows? Probably not. But if it does, I'll consider. So if AMD does reject the weekly 200 MA, I will consider getting in long AMD, close under, I'm out, stay above, I'm in, scale, all that stuff. IBB. Okay. IBB is iShares NASDAQ Biotechnology ETF. 200-day moving average here makes sense. There's some support here, a month's worth of support. We have the 200. Last time it got to the 200, it bounced. Is it going to get all the way down there? I don't know. But if it does, gives me a good risk to reward ratio. I will consider taking the trade. IWM, which is the Russell 2000, we talked about it on the daily. Let's also talk about it on the weekly. On the weekly, the 200-week moving average would make sense. Look, every time we got to it in the past, it bounced. It bounced. It bounced. Will it bounce this time? I don't know. Will it get there? I don't know. There's that long-term trend line as well on the daily. So this green area here, I mean, that's still quite a ways below. I mean, that's like 4.5%. But can it get there? You bet it can. You bet it can. Don't think to yourself it can't. Will it? I don't know. Probably not. But if it does and rejects the 200, that would give me a good risk to reward ratio. And last but not least, USO, which is oil, really got hammered in the last month. Okay, 200-week moving average would make sense. It's way down there. I don't know if it will get there. Let's look in the past. Did it respect it last time? It certainly did. Will it respect it this time? Maybe, maybe not. But again, it's probably a low probability that it will get there. But if it does, I will consider taking it. So yeah, it's been a crazy week. The market sentiment has changed dramatically, everyone. I hope you're, have yourself a plan, have yourself a process. If I can help you with that, please reach out to me. My email's in the description. Love to be able to teach you everything I know. Always like to meet new traders and hear their stories. But yeah, if we work together, I'll teach you everything I know. I like to think of myself that I'm a good teacher. I have a lot of patience, and it's important that my students succeed. So if it's of interest, just reach out to me. We'll have a Skype call, and I'll learn more about you, your trading, your challenges, your goals, and of course, it's a good time for you to ask me any questions about the course. As an alternative to the one-on-one, I do have a great online video course at udemy.com. The link is in the description. In the one-on-one, I teach you all 7 of the approaches that I use. But this video course is just the deep dip buy, which we've used a lot today. It's a great course, 9.5 hours of video. So there's a lot of content there to teach you step by step how to trade. And it's very affordable. I think it's somewhere between $30 and $50 for the 9.5 hour video course. So it's, affordably priced. I think there's 4.9 stars on that Udemy course. So, if you're interested, please go watch it. You will learn a lot. And again, if you like today's podcast, I would really appreciate if you could hit the thumbs up button or subscribe to the channel. I always forget to say that, but if you're not subscribed, subscribe. I put out a lot of videos. Sometimes I put out day trading videos as well. But if you have any comments or questions about anything I've discussed today, please put them in the comment section. I'll do my best to get back to them. But I always like to leave off with, please try to go out and do something nice for someone today. If we all did something nice for another person, it really would make this world a better place. You like it if somebody does something nice for you or an act of kindness for you. So why don't you repay and just do a random act of kindness? That would really make this world a better place if we all did that. And if you could do something nice for an animal, I would really appreciate that. I'm very, animals very near and dear to me. I was raised with many of them, and they like acts of kindness and appreciate them just like humans do. So thank you so much for coming today and investing the time. I hope it was helpful, and please be careful next week. And again, if you have any comments or questions, please let me know. Thanks a lot, everyone. Take care. Appreciate you being here. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice. and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.